Today, we're doing a complete breakdown of ASC 810. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a company with $200 million in assets that suddenly reveals an extra $100 million in liabilities due to hidden subsidiaries. ASC 810 transformed how companies report these entities. By the end of this section, you'll grasp how ASC 810 ensures transparency and consistency in financial reporting. ASC 810 emerged to tackle hidden financial risks in corporate balance sheets. Previously, businesses could exclude certain subsidiaries, leaving stakeholders in the dark about potential liabilities. By mandating consolidation, ASC 810 ensures that investors and regulators see a true, transparent picture. This standard closes loopholes, enhancing trust in financial statements by including all significant entities. ASC 810 is mandatory for entities under U.S. generally accepted accounting principles, coming into force in 2009. Its pivotal requirement: consolidating all entities under common control, including those with variable interests. This ensures investors see a complete economic picture. By understanding this, you'll appreciate how ASC 810 bolsters financial accuracy, ensuring no entity is left unreported or misleadingly excluded. The consolidation model within ASC 810 ensures all entities under control are reported, providing a clear financial picture. It evaluates control through voting rights and risk exposure, crucial for entities like special purpose entities. Mastering this model helps you articulate how detailed financial statements reflect comprehensive operations, a key topic in finance interviews. Recognizing these consolidation requirements underscores the importance of transparency and accuracy in financial reporting. Scope is crucial in applying ASC 810 effectively. Candidates often overlook that associates using the equity method are not included, a common interview pitfall. Knowing precisely where ASC 810 applies can make or break the accuracy of financial reporting, affecting how entities are consolidated or reported. ASC 810 applies to parent subsidiary setups, demanding consolidated reports. It includes variable interest entities where control isn't straightforward, but critical. Joint ventures are included if conditions align, ensuring accurate representation of financial influence. Understanding these inclusions helps in avoiding missteps in consolidation and reflecting true control dynamics. Being clear on exclusions helps in applying ASC 810 correctly. Associates using the equity method are outside the scope, a common interview trap. Investment companies, with their unique reporting, are also excluded. Recognizing when control isn't achieved keeps you from misapplying standards, ensuring accurate financial representation. Control in ASC 810 is about directing activities to obtain benefits beyond just owning shares. For example, a firm with substantial influence, like 40% voting rights and strategic agreements, might qualify as having control. It's essential to evaluate all factors, including contractual rights, to determine if control exists, ensuring proper consolidation. Understanding VIEs is key under ASC 810. These are entities where financial interest doesn't equate to voting power. For instance, special purpose entities might be controlled via contracts rather than equity. Recognizing and assessing VIEs ensure accurate reporting of entities where investors have substantial influence, despite lacking traditional ownership. Confusing edge cases often trip candidates. Consider a 30% stake with operational control. ASC 810 might apply if control is evident. For a real estate VIE with no majority interest, it's about influence, not voting. Joint ventures aren't automatic. Equal control doesn't always mean inclusion. Temporary control, like in bankruptcy, typically doesn't warrant consolidation under ASC 810. Imagine a parent company with several subsidiaries, each with financial complexities. The consolidation model streamlines reporting by determining which entities are included in the financial statements. It ensures accurate financial portrayal, crucial for investors assessing the overall financial health. This precision is vital when dealing with complex corporate structures, making ASC 810 indispensable for transparent reporting. The consolidation model assesses control over other entities, ensuring their financials are included in the parent company's statements. We'll follow Meridian Corporation, which has a $10 million SaaS contract comprising $8 million for software and $2 million for services. This example shows how entities are assessed and consolidated, reflecting true financial performance and obligations, crucial for stakeholders' decision-making. Identifying the reporting entity is the first step. In Meridian Corporation's case, we determine which specific entity is responsible for the $10 million SaaS contract. This clarity sets the stage for accurate financial consolidation. A common mistake is failing to clearly define the boundaries, which can result in missing critical financial data. ASC emphasizes including entities directly involved in significant transactions, ensuring comprehensive reporting. Now, with Meridian Corporation's entity identified, we tackle control assessment. Does Meridian control the delivery of the $10 million SaaS contract services? This step examines if Meridian influences financial and operational decisions. Misjudging control can skew consolidation outcomes. ASC highlights that control involves not just power, but also exposure to profits or losses, ensuring only genuinely controlled entities are consolidated. With control assessed, we evaluate Meridian Corporation's relationship dynamics in delivering the SaaS package. This involves examining vendor interactions that might affect control. The qualitative nature of these relationships can shift control dynamics. A common oversight is ignoring these subtleties, leading to flawed consolidation. ASC insists on evaluating contractual and real-world interactions to ensure decisions reflect true organizational influence. Meridian Corporation now consolidates its controlled entity's financial statements, reflecting its $10 million SaaS contract in its own accounts. This consolidation ensures transparency, showing the true scale of operations and obligations. A frequent error here is failing to account for all inter-entity transactions, which can distort financial clarity. ASC mandates full inclusion to provide stakeholders with a complete financial picture, crucial for sound decision-making. Finally, Meridian Corporation must eliminate all intercompany transactions related to the SaaS contract. This step prevents double counting, ensuring the consolidated statements reflect true financial performance. A common pitfall is incomplete elimination, inflating reported figures. ASC stresses precision in this process to uphold data integrity, delivering accurate financial insights to stakeholders. This meticulous approach concludes the consolidation journey, ensuring clarity across financial reports. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 810 offers a framework for fair and accurate reporting, ensuring financial statements reflect true economic realities. Understanding these choices and disclosures can safeguard against significant financial misstatements. Initial recognition under ASC 810 hinges on becoming the primary beneficiary of a VIE. This happens when you gain control, often through acquiring more than 50% of voting interest. At this point, measure at fair value, ideally using market prices, or, if unavailable, alternative valuation methods. Control can also be established via contractual rights, serving as a critical recognition trigger. After initial recognition, ongoing assessment of control and VIE status is crucial. Fair value changes should adjust carrying amounts, impacting financial statements meaningfully. Non-controlling interests must also be measured at fair value, affecting the equity section. Additionally, impairment testing is vital. Any decline in asset values requires adjustments to prevent overstatement. Such vigilance ensures financials remain accurate and compliant with ASC 810. ASC 810 mandates that consolidated assets and liabilities of VIEs be reflected on the balance sheet, enhancing transparency. Income and expenses from VIE operations appear in the income statement, offering insights into performance. Non-controlling interests must be clearly shown in the equity section. Additionally, comprehensive notes are essential to elucidate the nature and risks associated with VIE involvement, ensuring users understand the financial implications and context. Disclosures under ASC 810 provide critical insight into a firm's involvement with VIEs. The nature of these relationships must be disclosed, offering clarity on risk and control. Rationale for being the primary beneficiary is required, enhancing understanding of consolidation decisions. Separate reporting of VIE assets and liabilities aids in precise financial analysis. Lastly, non-controlling interests are disclosed to delineate ownership stakes, impacting how influence and control are perceived. Imagine a CFO navigating a $5 million VIE acquisition. First, they confirm control and measure assets at fair value. Quarterly, they reassess and remeasure these assets to align with market changes. With a $1 million non-controlling interest, this equity portion is transparently reported. Comprehensive disclosures follow, detailing the firm's VIE participation and its financial impact. This approach not only ensures compliance, but also promotes a clear understanding of financial health and risks. Meridian Corporation, a global manufacturing company, acquires a 60% interest in a smaller competitor for $1,200,000. Discover how this acquisition impacts their financials under ASC 810, from initial recognition to subsequent adjustments and eventual consolidation. The initial investment of $1,200,000 in the subsidiary is recorded as an asset under investment in subsidiary. This entry reflects ownership and control over the subsidiary, aligning with ASC 810 requirements for consolidation. Meridian Corporation's cash decreases by $1,200,000, impacting liquidity, but potentially enhancing future revenue streams. The non-controlling interest is recognized at $800,000, representing the fair value of the minority stake in the subsidiary. ASC 810 mandates that non-controlling interests be presented within equity, not as a liability, highlighting the separate ownership interest. This ensures transparency in the financial statements regarding ownership distribution. Consolidation of the subsidiary's assets at $2 million distinguishes Meridian Corporation's enhanced financial position. ASC 810 requires all assets of controlled subsidiaries to be included in the parent company's balance sheet, ensuring a comprehensive view of resources and capabilities. This action boosts total assets and can improve leverage ratios. Consolidating liabilities of $1 million reflects Meridian Corporation's acknowledgement of the subsidiary's debts. ASC 810 requires these liabilities to be recorded on the parent company's balance sheet, ensuring an accurate depiction of financial obligations. This affects leverage and risk assessments, crucial for stakeholders and potential investors. The subsidiary's income allocation of $200,000, with $80,000 directed to non-controlling interests, aligns with ASC 810's equity method. This ensures fairness in earnings distribution, maintaining transparency for minority shareholders. This income boosts Meridian Corporation's consolidated net income, enhancing overall profitability metrics. Dividends paid by the subsidiary total $50,000, reducing cash and impacting non-controlling interest by $20,000. Per ASC 810, dividends to minority shareholders adjust equity, not profit. This dividend distribution reflects the subsidiary's financial health and cash flow capacity, influencing Meridian Corporation's consolidated cash position. The $100,000 loss from the subsidiary is reflected in consolidated income, with $40,000 impacting non-controlling interest. ASC 810 ensures losses are shared proportionately, maintaining equitable treatment of minority interests. This loss impacts Meridian Corporation's profitability, necessitating strategic adjustments to sustain financial health. Selling the subsidiary results in its derecognition, with a $2,500,000 cash inflow. The investment account is zeroed per ASC 810, reflecting the cessation of control. This sale impacts the financials, with cash flow significantly boosted and asset composition changing, offering new capital deployment opportunities. Every Big Four and investment bank interview on ASC 810 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The accounting logic behind this: what is ASC 810? What interviewers focus on here? What is a VIE? Here's what makes this important: consolidation versus Indian accounting standard. The key insight here: recording non-controlling interests. What every finance professional needs to know: impact of intercompany transactions. Here is the core idea. Scenario: VIE, consolidation. This is where the standard gets specific. International Financial Reporting Standards versus ASC 810. The accounting logic behind this. Scope of ASC 810. What interviewers focus on here. Disclosure requirements. Here is what makes this important. Trick. Control definition. Understanding ASC 810 basics is crucial for grasping consolidation. The objective is clear. Ensure transparent reporting of investments in subsidiaries. It covers entities with control, defined by significant influence over activities and benefits. Key concepts include variable interests and voting rights, both pivotal in consolidation decisions. Subsidiaries, entities controlled by a parent, must consolidate financials. Remember, non-controlling interest represents ownership not held by the parent. Mastering the core model and measurement under ASC 810 involves understanding key aspects of consolidation. The focus is on determining control through power and benefits analysis using consolidation tests. Subsidiaries' financials are measured at fair value, with goodwill arising from business combinations. This goodwill is not amortized, but requires annual impairment testing. These elements ensure accurate representation of a parent's financial interest in its subsidiaries. For interviews, grasping ASC 810 nuances can set you apart. Know when control arises from ownership or contracts, especially with variable interest entities. Non-controlling interests appear as separate equity, crucial for disclosure. ASC 810 emphasizes control, differentiating from other standards. Goodwill impairment impacts earnings, so understanding impairment triggers is vital. Remember, ownership changes don't always lead to deconsolidation, affecting consolidation continuity. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.